Hey guys, welcome back to another quick video. Today I'll be talking about gold leasing and explaining how that process works. Now, I think it's really important to start off by talking about what a lease actually is. A lease is a contractual agreement calling for the leasee, the user, to pay the lessor, the owner, for use of an asset. Some unique assets that are leased are fitness equipment by gyms, laundry equipment by dry cleaners, cleaning equipment maybe by the cleaners in office spaces. A surprising one, which is art. Probably many times when you go to like fancy office buildings, you'll see that there are a lot of beautiful pieces of artwork. Many of those are actually leased. Also, fire trucks, police cars, and ambulances. A lot of the smaller municipalities that can actually afford to buy them outright, what they do is they actually lease them from larger municipalities, right? And of course, probably the most common one that a lot of people know about is cars. Now, how does a car lease actually work? When first leasing a car, the dealership will calculate the current capitalized cost and the expected residual value after the projected lease period. Ultimately, you pay for the difference between the car's value at the beginning of the lease and what you expect it to be worth at the end. Instead of your payments building equity, like when you make your mortgage payments, you simply make these payments to use the car during that lease period. Okay? Now, how is a gold lease different? Well, there is a key difference between a gold lease and a regular lease like the one for a car. For the car lease, the same car that was given to you must be returned. However, for gold, if assuming the same purity, a different ounce of gold can be returned at the end of the lease. This means that it is interchangeable with any ounce of gold on the market. It is not a distinct asset in the lessor's point of view. So consider this. Say, for example, you go and you take out a lease on a new Series 5 BMW 2016, right? 2016 edition. Now, after that 2-year lease period, you're not going to come with another BMW Series 5. What you're going to come back with is the exact same car, the same serial number, everything, right? It's the same car that you have to return. That's not the case with a gold lease, right? It doesn't make sense for you to take out that gold, hold on to it, and then give that same gold back, right? So a gold lease is more easily compared to a loan. When I give you $100 as a loan, at the end of the month, I don't expect you to give me the exact same $100 bill. Instead, I just receive another dollar bill, which is equivalent in value, of course, plus any additional interest. This is the same for a gold lease. When I lease 1 ounce of gold to you, I don't expect you to give me the exact same ounce back at the end of the month. I just expect to receive 1 ounce of gold plus interest. So why lease gold? In this market, gold is similar to money. For the bullion banks, which hold gold as debt to their customers, it would be unwise to just let it sit in the vaults. Instead, during the length of that debt, the bank can lease it out and earn additional revenue on the asset. This is similar to banks and the money in their vaults. Although they hold a certain amount on reserve, which is defined under the reserve requirement rate, the other portion is put to work by making additional loans. Right? And that's really the multiplier effect that exists in the monetary system. When you deposit your money, that bank is not going to hold on to that cash. What they're going to do is they're going to hold a little bit of it back, and then the other half, they're going to put it back into the system by producing a loan, by giving it out as a loan, and et cetera, et cetera. And so that multiplies the thing. Now, gold is fixed in supply. But similar to that, when a customer deposits gold with the bank, what happens is, then I can take that gold and then lease it out, earn additional revenue, but lease it out for a period where I know that customer is not going to come back and ask me for that gold to redeem their gold, right? So I lease it out for maybe a year or two, and then after 2 years, when they come back and they're like, hey, I want my gold back, that lease ends, and you give them back that gold, and actually, in the meantime, you actually earned a little bit of revenue while holding that, okay? For the bank, the lease offers reduced risk. Now, the traditional way of earning a return on gold was to sell it in the open market during that 2-year period when, the customer doesn't want it, and invest the proceeds while securing a forward contract for delivery back at a later date. So I would sell that gold, invest it in a very safe bond, get that yield, and then after 2 years, when the customer is assumed to return back, I secure a forward contract today when I initially sell it for that respective date. And on that respective date, I then receive that same amount of gold back. Okay? Now, the gold lease offers a much more simple and profitable way. Now, who uses a gold lease? The precious metals leasing market. So it's not only about gold. There are a lot of other precious metals that are leased, but this video focuses on gold. Now, the precious metal leasing market is incredibly large. For gold leases, a few key consumers come to mind. Now, there are the gold mining companies, there's the jeweler, and there are manufacturers who use gold to make their products. Now, the miner. Mining companies are the best example. Their revenues come from the refined ore they sell in the open market to generate profit and pay the bills. So whatever gold they produce, for them, just as any other business, that's their product. They sell it, the revenue that they get, they pay their bills, and then the profit remains for the owners. However, if the production schedule assumes production at the end of the month, and salaries and other expenses need to be paid at the start of the month, where does the money come from? In a scenario where they're expected to start production at the end of the month, you can't, a general bit like a shoemaker, he can make a shoe at any point in time. But with mining companies, there are set production schedules. And if their set production schedule assumes that they're going to start generating revenue at the end of the month, while their bills are due at the start of the month, how are they going to make up that difference? Through a gold lease, they can borrow X amount of ounces to sell in the open market and pay the bills. Once production starts, the same X amount of ounces is put to the side plus additional interest to pay back the lease. The gold lease in this scenario is a vital cash management solution. Now, what about the jeweler? Another example is the jeweler faced with a Macy's order for, say for example, 3,000 gold rings. With the order expected to take about half a year to fill, the jeweler can take out a lease, use the gold to fill the order, and then once he receives in full his payment, go to the gold market, buy the ounces he leased, plus any additional interest to pay back the lease. This ensures protection against price volatility, especially in a bear market where prices are falling. So in a scenario where the jeweler looks at the gold market and is like, it's probably likely that I'm assuming the price of gold is going to fall by 10% in the coming 6 months. I don't want to buy this gold now to see that my inventory value has fallen by 10% in the meantime while I'm producing this gold. So instead, what I do is I take out that lease. I use the ounces today in order to fill that order. But really, the payment, what I'm paying for in the market, is that 10% lower price 6 months from now, right? So the gold lease can also be used to ensure protection against price volatility. Now, what about the manufacturer? Consider the manufacturer who uses gold as a catalyst, which is a substance that increases the rate of chemical reaction in its production process. Although the gold is still within the chemical solution, the reclamation process takes time, and in order to move to the next batch, they can take out a gold lease. A gold lease can actually help with inventory management as well. So in certain scenarios where manufacturers use gold to speed up the chemical reaction in whatever they're making, right? The gold that they use in that chemical reaction, it's still there. They just need to sort through it, find it, clean it out, and then kind of get it back to its original state. But that takes time. And if you are a company that's trying to meet orders on a very rapid basis, what's going to happen is you don't have that time to clean up that gold and use it again. So what you do is you lease out gold so that you can focus on your next batch while you allocate maybe a few employees to clean that gold and cover that lease, right? So that's also helpful in inventory management. Now, understanding the impact of gold leasing on the market, this is a concern that a lot of people have. Hopefully, you haven't read any other articles, so you're unbiased when you're first reading this. Now, the number of gold leases actively taken out increases during a bear market. A lot of people assume it's the opposite. It increases during a bullish market, right? Because, the market's booming and everyone's taking out. No, it sounds confusing, but consider this. If the price of gold is expected to fall by 5% in the next year, and the annual gold lease rate, this is the similar to an interest rate when you borrow money, the gold lease rate, the GLR, is 1%, what can actually happen? Well, I can take out a lease now, sell the gold in the open market today, realize the 5% higher price. And in a year's time, when the price of gold falls by 5%, I can then use some of those proceeds from the initial sale, buy back the same amount of ounces, and then cover the 1% interest rate. And net overall, what happens is I actually get a 4% return on my investment. So nowadays, there are a lot of derivative products that can be used to short the gold market, but that's paper gold. That's not actual physical gold. It's a derivative. It derives from an underlying asset. In the original gold trade, if you want to focus on the physical trade of gold, the way to short a market is through the gold lease. And so that's why the number of gold leases in the activity of the gold lease market increases during a bear market. So during the late 1980s and 1990s, the gold market was in a bear market. And as you can see in the GLR the graph over here to the right, oops, where's my mouse? Yeah, so the GLR graph over here, it was significantly higher. So initially it continued to increase in these spikes during seasonal heights, right? So almost hit 6%, the GLR rate, and it actually hit about 9.2% really at the peak of the bear market, right? So at the trough. Right? Now, what about in the current zero interest rate environment today in 2017, 2016? Would demand be high or low? Well, really, it's dependent on the price of gold, right? Where is the price of gold? Well, relative to this time period, it's significantly higher, right? So we're assuming that the gold lease market is going to produce an activity. And so that's exactly what happened. So post 2001, really, what happens is that, the price of gold continues to increase, especially during that boom period before the financial collapse. And so the gold lease rate is close to zero. Then, of course, the financial collapse occurs. There's a significant assumption that the bear market ensues, right? And so the gold lease rate increases, but gold actually continues to increase in value really through that recession. So gold increases, and it's actually negative. So the gold lease rate was actually negative between 2009 and 2012. Now, how is this possible? Well, in this scenario, really what happened is that if you really wanted to take out a lease, the banks would actually pay you to take their gold, right? Now, this is really more of a kind of like numbers error than anything else, because the gold lease rate is the difference between LIBOR and the gold forward offer rate, which is shorthand is GOFO. Right? So the difference between LIBOR and GOFO is the gold lease rate. And so in this scenario, when the central banks, the global central banks really cut interest rates in order to stimulate economic performance, what happens is that difference between the two declined significantly, and it actually went negative in some months. Right? Now, of course, because it was such a bullish market in the gold market, especially up until 2011, not a lot of people were using these leases, right? So not a lot of people really saw an advantage in profiting from these negative gold lease rates, but they still did occur. Now, just to talk about GOFO just a little bit, I don't want to confuse you too much, but covering GOFO is the swap rate for a gold to US dollar exchange. It is the rate at which someone is ready to exchange gold for the greenback. It is essentially the interest rate on a US dollar loan when gold is used as collateral. So your general bank interest rate when you take out a loan of US dollars, that's the general rate. Now, the GOFO rate is, say, for example, you use gold as collateral for that loan. That's the only difference. What is the rate? Well, of course, this can be a little bit less than LIBOR because really you have that collateral. And the difference between the two essentially captures that gold lease rate. So LIBOR would be your loan, like very simplified, assuming no additional premium. LIBOR would be the base level of what a unsecured US dollar loan would charge, versus GOFO, which is a loan with gold as collateral. So the difference between the two is that lease rate. Now, of course, as we talked about before, you see, so this yellow line over here is the price of gold. And so we had that bear market. It was declining significantly. And then as it continues to increase during that bullish market, the GOFO rate fell. And that makes sense. As the value of your collateral increases in value, the interest rate that's charged lowers, right? So your GOFO rate was falling really even post 2009 in this area because gold is, again, in certain circumstances, a safe haven, right? So the value of gold was increasing during that period while interest rates were falling, and all of a sudden you got negative gold lease rates. Okay, so that's easy to understand. But the key takeaway to take away from this is that for gold leasing is booming during bear markets, and it falls significantly during bullish markets in the gold market. Okay. So to summarize, a gold lease is not like a car lease. A gold lease is more similar to a loan. Gold miners use gold leases, jewelers use gold leases, manufacturers use gold leases, and there is an inverse relationship between the price of gold and the gold lease rate. As always, if you like this video, please like and subscribe to my channel for more. I would recommend that you check out my videos on the new case for gold. It is a book by James Rickards. He is a commentator in the gold market, and I kind of cover his book and the different topics covered in each of the chapters, in addition to some of the commentary that I have for some of the points that he proposes. So if you are interested in kind of the gold market, I do recommend that you check out those videos. But as always, have a nice day, guys.